Good afternoon. Thank you for joining us for today's webinar, Summary of CARES Act and FFCRA Provisions, presented by Rea Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. Today, we're partnering with the Greater Medina Chamber of Commerce. We would like to thank you for joining us today. We're happy to have Rea present for your members. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. If you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. Also, if you'd like a copy of today's slides, you'll find that they're available in the handout section of the webinar dashboard on your computer screen. Please note that the resources presented today are for informational purposes only. Rea Associates does not provide legal advice and will not make any management decisions for your organization. You're encouraged to consult with legal counsel of your choice prior to implementing any policies or procedures within your organization. Today's webinar will be given by Paul McEwen and Renee West. Paul McEwen is a principal at Rea Associates, where he leads the firm's retirement plan consulting and administration services team. He is responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. With more than 30 years of accounting industry experience, his areas of expertise include retirement plan, fiduciary issues, plan compliance, and reporting issues. Renee West is a senior manager and leader of Rea Associates HR consulting practice. With more than 27 years of experience in human resources, Renee specializes in assisting organizations within the manufacturing, nonprofit, contingent staffing, food, and other industries with their HR challenges. She is also currently serving on the Ohio Society for Human Resource Management's Board of Directors as Central District Director. Today, Renee and Paul will help employers gain a better understanding of the FFCRA provisions and how they can comply with the new regulations during this time. And I will pass it on to Paul.
All right, Imani, can you hear me okay?
I can.
All right, terrific. Well, good afternoon, everybody. It is a pleasure for Rea Associates to partner with the Medina County Chamber of Commerce to present information on the CARES Act and specifically certain provisions within the CARES Act as well as FFCRA. As Imani went through my bio, I had to chuckle. I don't know that anybody is when they're born or when they start their career says they want to be an expert in the PPP Loan Program, but I volunteered for that job at Rea Associates, and so for the last 6 weeks or so, I've been talking with clients and doing research and trying to become as familiar as possible with the PPP Loan Program. We've been at this now for about 6 weeks or so, and I just thought today, I'm going to guess, unless you live under a rock, you're probably familiar with the basics of the PPP program. So we're going to just go over a brief overview of the program for those that may not be completely up to speed, just to make sure we're all at a basic common understanding. And then we're going to kind of walk through some of the details of the forgiveness process. A lot of the questions that I'm dealing with right now are from clients that are struggling with trying to interpret the rules related to the forgiveness process under the PPP Loan Program. So we're going to spend some time doing that. And we're going to talk, I'll give you an update in terms of the EIDL, which is also known as the Disaster Loan Program through the SBA. Give a brief overview of that program. I'll let you know what the current status is on that. I think everybody's probably heard of that program as well. And then we're going to go through briefly just so everybody's aware, there is some other existing SBA loan relief. If you have other SBA loans at your organization, there is some available loan relief through the SBA. So we'll touch on that. That was part of the CARES Act as well. And then we're going to hit the employee retention tax credit issue or opportunity, and then the deferral of the payroll tax payments as well, and kind of how those two provisions within the CARES Act relate and correlates with the PPP loan program. Next slide, Rebecca. I'm not seeing the slide go. Oh, there we go. And then we're going to hit the highlights of the Main Street Lending Program, which has not started yet, but it's also another part of the CARES Act. It's meant for larger companies. We're not going to spend a whole lot of time on that because it hasn't gone live yet. I heard this morning on CNBC that we're probably looking at another couple weeks before that will be available to employers. But we are going to hit, just so that you're aware of it and kind of how that program is intended to operate in conjunction with PPP. And then Renee is going to take over, and she's going to deal with the FFCRA, particularly the Family Medical Leave Act, emergency provisions, and EPSLA, as well as we're getting a lot of questions regarding unemployment, both as it relates to the PPP Loan Program, because clients are really concerned about getting employees back on payroll so that they can spend at least 75% of their loan amount on payroll costs. So getting folks back on payroll is important, and the unemployment benefits are so rich that a lot of our clients are having trouble attracting employees back. So she'll deal with that issue, as well as some best practices on return to work. She'll hit on some policies and employee handbook update issues, and then certain safety issues. And then she also has some additional resources to share with you, and she'll go into more depth on that. Rebecca, next slide, please. All right. So let's start with a high-level summary of the PPP program. So PPP program is an SBA loan program that's run through the banks, as distinguished from the disaster loan program, which was an online application directly with SBA. So you had to go through your banker, through your lender to initiate this process. Hopefully everybody's done that at this point. We've gone through a couple different rounds of funding on the PPP loan program, so I'm not going to waste any more time on that. But certainly if you have any questions on that, we can field those today as well. As an employer, you have to have no more than 500 employees. That does include any affiliated companies, and we just got some guidance within the last week or so that indicated to us that you have to include your foreign affiliates as well. Didn't impact a lot of our clients, but there were a couple that were right on the edge of 500 employees, and if you added in their foreign affiliates, it did throw them over. We can talk about that more in more detail if there's anybody in the audience that has that specific situation. Sole proprietors and independent contractors were included. There was some confusion initially as to whether independent contractors should be included in payroll. That was made clear that they should not be, that they can apply for a loan on their own separately. And then obviously not-for-profits are included as well, but specifically only 501c3 and C19 organizations. The loan limits were $10 million. Anything that's not forgiven is going to be a 2-year term. And that with a 1% interest rate. And the loan amount was based on really nothing more than 2.5 times your average monthly payroll in 2019. And so we spent a lot of time with clients early on helping them figure out how to do that calculation of average monthly payroll in applying for these loans. I think we're kind of beyond that at this point, but it is worth noting that the definition of payroll costs for purposes of the for purposes of the application, it's the same definition for purposes of forgiveness. So at least we have that amount of simplicity. Next slide, please, Rebecca.
Hi, Paul. I'm going to switch the slides over to my screen. Rebecca's delayed a little bit, so go ahead and talk through the other slide, and we'll be switching that over shortly.
Okay, I'm going to. Oh, there it is. Looks like you already got it, so we're good. So just continuing with the summary. So forgiveness was possible of the loan if you spent the entire loan proceeds within 8 weeks, and used at least 75% of the loan proceeds for payroll costs. The forgiveness was kind of the carrot that the Treasury Department through SBA threw out there to really try to get employers to spend the money as quickly as possible and get it in the hands of employees as quickly as possible. The other authorized or qualified expenses that the money can be used on is mortgage interest, rents, and utilities. We'll get into more detail there later. 2 rounds of funding, as I mentioned before. The first one started April 3rd with $350 billion. That was gone in 12 days. And they came out with another round of funding that started April 27th. That's when it became available, $310 billion. And the last time I checked, I think the last update I've seen, there were still about $100 billion left. And I have some theories as to why this might have lasted a little bit longer, but for sure, the average size of loans has gone down significantly with round 2. So I know that was a major goal of the SBA with round 2 and with Congress to make sure that smaller organizations had an opportunity to get some of this funding because with round 1, it seemed like there were a lot of larger loans that went out to larger organizations, and there was a concern that they were gobbling up the available resources at the expense of smaller organizations. So that doesn't appear to be happening at this point. And then only one loan per organization, and that's they're driving that off of your EIN. So regardless of whether you have a lot of affiliated companies, you're going to apply. Each one of those affiliates, assuming you're under 500 employees, each one of those individual affiliates could apply on their own using their own EIN. So that's how the loans are limited. And then it was specifically stated within the CARES Act that loan forgiveness is not taxable. But what we found out in subsequent guidance from IRS was unfortunately what they gave us with one hand, they took it away with the other hand, because even though the loan forgiveness itself is not taxable, any of the related expenses that you're using to get that loan forgiveness, such as payroll costs, interest, rent, or utilities, which are normally deductible 162 business expenses, Section 162 business expenses, they will not be deductible if you get that loan forgiveness. So it becomes a tax neutral result at that point, which there's been a lot in the press about whether that was really the congressional intent. So we may get some future guidance that or legislation that overrules that treatment by the IRS related to the expenses not being deductible. I'm hopeful that we'll get that. I definitely think the congressional intent was that the forgiveness not be taxable, but the expenses continue to be taxable. That was another carrot that, in my opinion, that was thrown out there to really encourage employers to apply for the program and to use the money to keep employees on payroll. We have to go. I keep reminding clients, the name of the program is Paycheck Protection Program, and it was not a small business bailout program. It was really meant to get money in the hands of employees as quickly as possible so that they could continue to make car payments, mortgage payments, lease payments, buy groceries, et cetera, and keep them out of the unemployment line. So I think there were a lot of things, the forgiveness provision in particular, as well as the 8-week period, were both designed with the idea that this money get to employees as quickly as possible. Next slide, please. All right, so that was a high-level overview. Hopefully that all sounded familiar to everybody. Didn't want to spend a whole lot of time on that today, but certainly if anybody has questions on that, we would be happy to talk about that. Or you can email us after the fact as well. The first big issue, and actually we just got direction on this today, so it's kind of exciting. This is the first presentation I've done with this information, but the first concern that was creating a ton of angst within our client group was the necessity certification. And essentially when everybody applied for the PPP loan, they had to basically certify or attest to the fact that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And at some point, it became public knowledge that certain large public companies had applied for these loans and received them and been approved. And there was some political backlash relating to that. And I think probably going all the way back to the 2008-2009 timeframe when big banks and Wall Street got bailed out at the expense of Main Street. And certainly Congress didn't want that happening again as well. But interestingly enough, Congress, when they designed the program, expanded eligibility to include large restaurant chains because that's where a lot of the laid off employees were, and they wanted to help those folks. And so they actually expanded the eligibility for the program, which was the only reason those larger public companies were able to apply under the program in the first place. So they kind of moved the goalposts on everybody. We weren't sure how this was going to play out. Then we got some guidance that you really needed to, if you had other resources, you really should take a hard look at whether you really needed this loan. There was a lot of created a lot of concern within our client base of employers wondering, okay, if I had money in the bank, or I had access to a line of credit, or if I had deep pockets with owners, if we had to tap those resources before we tapped the PPP loan program. And we really didn't have much to go on until today. And so today, I think the way I phrased it internally this morning when I first read this FAQ, the SBA has been pushing out guidance in the form of FAQs. So FAQ number 46 came out today, and it basically, the SBA has punted on this issue effectively. And so they created a safe harbor so that any loan under $2 million is now automatically deemed necessary. You don't have to do anything. If you have a loan, and so that's going to be the vast majority of these loans. You look at the kind of the spectrum of these loans, it's a very small percentage that are over $2 million. I don't know the exact number off the top of my head, but percentage terms, it's a very small percentage. So that safe harbor alone will take care of the vast majority of employers taking a loan. So they don't need to now second guess anymore whether they should have used existing cash, lines of credit, whatever, to pay employees instead of applying for the PPP loan program. You are now deemed, it was deemed necessary for you to apply. So you don't need to worry about that anymore. Any loan over $2 million will still be reviewed by the SBA. And if it's deemed necessary, you simply will have to repay the loan. There will be no criminal penalty. And that was the other thing that was creating a ton of angst with our clients was SBA indicated that there could, if you didn't apply in good faith, there could be criminal sanctions against the employer or whoever the authorized personnel were that applied for the loan on behalf of the employer. All of that's gone away at this point. So now there really is no downside to having applied for the loan. If upon review, and again, we don't have a whole lot to go on in terms of how do you know whether it was deemed necessary or not for those companies that took more than $2 million. But what we're telling clients is documentation is absolutely critical. So that means, did your revenues, have they declined? Have you done projected cash flows? Are your projected cash flows reduced? What kind of uncertainty is there within your industry? Certainly different industries have been affected to different extent in terms of the impact of the virus. And so what was the impact on your industry and specifically your company? Document any meeting minutes you might have had with board of directors, et cetera. And that one of the things that we certainly talked about at Rea Associates, and I know a lot of our clients did as well. What was your prior experience with the Great Recession back in 2008, 2009? If you, there we go. If you had a significant decrease in cash flow, this downturn in the economy resulting from the virus is going to be a lot worse than that experience. So if you had a bad experience then, it's logical to think that you're going to have a downturn in revenues related to this economic crisis. So I would just say documentation is critical. If you, and one of the things that I've been asking clients, it seems to kind of cut to the chase, is this: if you had not applied for the PPP loan program, would you have laid off employees? And if you can honestly say that you would have laid off employees, but for the fact that you got the PPP loan program, then you applied in good faith, and you should have applied for the program. And I think that's the way it's going to come down. There's no expectation by the government that you dip into savings to do a patriotic act to keep employees on payroll. Anybody who runs a business knows that when revenues go down, you have to control costs, and one of the big costs that all companies have is payroll. And so, unfortunately, that's what happens in an economic downturn, is people get laid off. And the purpose of the program was to give companies money so they wouldn't have to do that. So anyway, there was a safe harbor deadline to return funds of March 14th, which is tomorrow, which is really why we planned the program for today. But that is really going to be kind of a moot point at this point. I don't know that I would recommend anybody return the money at this point based on this guidance. Again, it was received today. I know of a lot of companies that returned money based on scare tactics from SBA and some of the language that was being bandied around in the media as well as in the press. And unfortunately, it's not the companies that are going to be hurt. It's actually their employees that are going to lose out. And so that's, in my opinion, a real shame. But anyway, let's go to the next. That's the whole necessity certification issue. So if you're now let's turn to look at forgiveness. And again, we want to look to see how do we calculate payroll costs. And I mentioned before, payroll costs are going to be calculated the same way for forgiveness as they were for the application itself, which is good. So you're going to start with your gross W-2 compensation. You're going to add in group health care benefits. But this is not going to include if you're an LLC or a partnership or sole proprietor or an independent contractor. Those self-employed owners or partner members are not going to be able to add in their group health benefits or their retirement benefits. But if you have employees, you're going to add in all of their payroll plus their group health care benefits plus their retirement benefits plus any state payroll taxes. Lots of clients have asked us about workers' comp premiums. What we've told them in Ohio, there have been significant workers' comp refunds given out. So because it isn't specifically addressed in the CARES Act, it is a state level payroll related expense. So, and it is healthcare related. So we've been telling clients to kind of keep it on their list. Let's see if we get any guidance. But if you do decide that you want to include workers' comp premiums in your definition of payroll costs for purposes of forgiveness, I would say that you need to include the net amount, less any refunds that you've received from the state. And in many cases, I think the refunds have been greater than the premiums. So I think this may be a moot point for many organizations, but we have gotten a lot of questions regarding workers' comp premiums. And then you're going to take away any compensation, or you're going to deduct any compensation for any employee that's over $15,385, which if you annualize $15,385 for the 8-week period, that's $100,000. So basically, anybody who's making more than $100,000, you need to limit them to $15,385 during the 8-week period after the loan is received. So any compensation over that would be a reduction in your definition of payroll costs for forgiveness purposes. Next slide, please. Sole proprietor and SN LLC. just wanted to we've gotten a lot of questions on how do I, if I'm a sole proprietor or I've got I have an LLC that I'm the only the only owner of. How do I calculate my quote unquote wage, and how do I document that for purposes of forgiveness? So you're going to be limited to the lesser of 8 weeks. Again, this is an identical definition in terms of the application. You're limited to lesser of either 8 weeks of 2019 net profits based on Schedule C of Form 1040, line 31, which is your net profit amount, or $15,385. So you're not going to be looking at 2020 net profits at all. You're going to be looking only at 2019, and to the extent that 2019 is above $100,000, you're going to be limited to $15,385 during that 8-week period. And again, no health insurance costs and no retirement plan contributions. For partners and LLC members, very similar in terms of no health insurance costs and no retirement plan contributions. And again, that's just for the partners or the members of the LLC. Doesn't apply to employees. You're going to be limited to the lesser of 8 weeks of your 2019 allocable net profits based on K1, Schedule K1, Box 14A. You're going to reduce that by any Section 179 expense deductions or unreimbursed partnership expenses claimed and depletion claimed on oil and gas properties, or that same $100,000 limitation, which is $15,385 during the 8 weeks. So hopefully that's clear. In terms of how do you document that, you're going to have your 2019 forms as indicated there, and then you'll just want to document, at least this is the way I would do it, I would just document when you take those draws from the loan proceeds to pay yourself. Next slide, please. So the loan forgiveness requirements. At least 75% of the loan forgiveness must be used for payroll costs. There has been some confusion. We've gotten a lot of questions regarding, keep track of my time here, regarding is it 75% of the loan amount or is it 75% of the loan forgiveness? My take on it is it's a little bit of both. Essentially, and the guidance is really confusing. And we're hoping to get some additional guidance, frankly. But as long as you use 75%, well, what I tell clients is goal number one should be to spend all the loan proceeds. Goal number two should be spend all the loan proceeds within the 8-week period. And goal number three should be, if to the extent that you can, 75% of those dollars that are spent, those loan proceed dollars that are spent, should be for payroll cost purposes. If you can do that, that gives you the greatest opportunity to achieve 100% forgiveness of your loan. So I say that, but I do believe that 75%, if you're not able to get to that 75% requirement, there is a concern out there that some people think that if you don't spend 75% of your loan proceeds on payroll, that you'll have to pay back all of it. You won't get any of it forgiven. I am not of that opinion. I believe 75% of the loan, I think it's going to be a sliding scale. So to the extent that you can spend any portion of those loan proceeds on payroll costs, they will be forgiven. But your forgiveness will obviously be reduced. The entire loan amount is not going to be forgiven. So getting back into my bullet points here, at least 75% of loan forgiveness must be used for payroll costs. The other 25% must be used on those other costs we talked about, mortgage, interest, rent, and utilities. You're going to spend the loan proceeds within the 8 weeks. And so even if you get beyond the 8 weeks, if you've got some leftover money that you weren't able to spend within the 8 weeks, just continue to spend that money on payroll costs and those other costs mentioned, interest, rent, and utilities, and you're not going to have any trouble in terms of having to pay the money back immediately. Essentially, anything that's not forgiven is going to be termed out over a 2-year period at 1%, which is not a bad deal either. The SBA, and a lot of clients are confused about this too, there will be a loan forgiveness application that you are going to have to fill out. And I think, frankly, that's going to answer a lot of the questions that everybody has right now in terms of how does this loan forgiveness calculation work and what order do you take the reductions. But we haven't seen that yet. The first 8-week periods are going to start to elapse in the first full week of June. So this is going to be an issue here pretty quickly, and so hopefully we're going to see this loan forgiveness application soon. But you're going to fill that out and you're going to give it to your lender, and your lender's going to review it, and they're the ones that are going to, and you're going to provide them with all your documentation for your expenses as well, and they're going to be the ones to approve the amount of your forgiveness. Any loan proceeds not forgiven must be repaid. I already said that. So next slide, please. So there are a couple other reduction requirements when looking at the loan forgiveness calculation. One has to do with head count, which is on this slide. The other one has to do with wage reductions or salary reductions for specific employees. Let's deal with the head count requirement first. You're going to compare your average FTEs. So FTE, this is the only place within the PPP loan program where they talk about FTEs. We believe they're going to be based on 30 hours, same as the Affordable Care Act in terms of what is an FTE. Anyway, you're going to compare your average FTEs during the 8-week measurement period. So you're going to look at each one of your payroll periods during the 8-week measurement period and take an average of your full-time equivalents for each of the payroll periods, and you're going to compare that to a pre-crisis period of your choosing, and they give you obviously two to choose from, one in 2019 from either February 15th to June 30th, or the first 2 months of 2020, whichever one is most advantageous to you. And then based on the average of each payroll period during the measurement period, or I already said that, and you're going to use the period that's most advantageous. And so if you have a reduction, then you're essentially going to multiply your loan forgiveness amount by that ratio of your average FTEs during the 8-week measurement period over the average FTEs during the pre-crisis period. But if you restore your head count by June 30th, then you won't have this reduction, and we'll talk about that on the next slide. So here's the reduction of forgiveness related to salary and wages. If any employee has wages or salary decreased by more than 25%, then the amount in excess of 25% reduction will reduce the loan forgiveness amount. This is going to require a lot of guidance that we haven't gotten yet, because essentially what they want you to do is compare the wages or salaries of each employee during the 8-week period to the most recent full quarter during which the employee was employed before the 8-week period. Well, if you just do the simple math, you take 8 weeks, and a quarter is 12 weeks, you're looking at 67%, and they're saying you can't have a reduction of more than 25%. So I'm not sure how this math is going to work. I don't know if what they're looking for is a rate as opposed to actual wages paid. Presumably we'll get this guidance, or it'll be contained on that application for forgiveness that I referenced earlier. And then the last point there, if the headcount and wages of salaries are restored to pre-crisis levels by June 30th, then there's no reduction. Next slide, please. Group healthcare benefits, I think we already hit on some of this. You're looking at fully insured premiums, and I've gotten a lot of questions on this. Hey, I'm self-insured. What do I include for group healthcare benefits? So what we're saying is, again, no guidance, but I think what makes common sense is claims, admin fees, stop loss premiums, any other fees that you might have associated with your providing of group healthcare benefits. I don't know what those might be, but I think claims, admin fees, and stop loss premiums are the majority of what most self-employed employers deal with. So I would include all of those. As far as retirement benefits, it's going to be any employer-paid SEP, simple 401k match, or safe harbor, profit sharing or defined benefit plan contributions. There really is not a whole lot of qualification on retirement benefits yet. There is this concept that it's costs incurred and payments made during the 8-week period. So we're not quite sure what that means. Is it cash basis? Is it accrual basis? Is it some combination thereof? I would say if you're paying for retirement plan costs that have been incurred, like they're from 2019, but you just haven't paid them in yet, I would go ahead and put them on your spreadsheet. Plan to include those unless we get guidance to the contrary. Certainly any safe harbor contributions required up and through the end of June, I would include. But for 2020, if you normally do a profit sharing contribution in 2021 for the 2020 year, I would not pay those in at this point. I think we are going to get some guidance that basically says you can't prepay retirement benefits or any costs for that matter. So I would just be careful in terms of making any large prepayments of retirement benefits. So that's what I said in the last paragraph. Next slide, please. So mortgage interest, just real quickly here. I had a lot of questions regarding what is mortgage interest. So that's a business mortgage obligation on real and personal property. I've seen examples that they've used in guidance related to real property and to personal property vehicles. So I think we need some more guidance on that. But the Act does specifically reference real and personal property, although you don't normally take out a mortgage on personal property. So that, to me, that's a little bit of a conflict. Rents, business rent payments, that can be a warehouse or a vehicle. There's specific guidance in one of the interim final rules regarding that. Really no other qualifications. We think self-rentals will be okay. A lot of our clients have a separate entity that owns the real estate, and they pay that other entity a reasonable amount of interest. I would just say make sure it's market-based, it's reasonable, make sure it's consistent with pre-crisis rents. Don't jack up your rents just so that you can use up the loan proceeds. You'll probably be okay. But not a whole lot of qualifications or guidance on rents at this point. Utilities, what we're saying is electricity, gas, water, phone, internet. The Act throws in transportation. The only definition I've seen there for transportation, had a lot of questions on that. It's gas for business vehicles. And that could be a big number or a small number depending on your business. So, but that was an example given in some of the guidance. So just throwing it out there. I'm hoping we get additional guidance before we have to apply for forgiveness. Next slide, please. So the EIDL program, I think everybody's familiar with this. It was kind of a parallel program, but it wasn't based on payroll. You applied directly through SBA. There's a grant program that went along with it. It's basically $1,000 per employee. A lot of our clients have gotten this money. In addition to that, loan amounts, right now what we're hearing unofficially is they're up to $150,000. They were supposed to be up to $2 million, I think was the original limit, but they're trying to spread the money out. Right now, they've been overwhelmed with applications. They're limiting new applications to agricultural businesses, which kind of got shut out in the first round of funding. We're in a second round of funding with this as well. They're basically processing any applications that had been applied for before the money ran out, as well as any new applications from agricultural businesses only. They were 30-year term at 3.75%, 2.75 for nonprofits. But right now, unless you're an agricultural business or you already applied and you're still waiting to hear, you're really not, this program is no longer available. Next slide, please. Small business debt relief. Just want everybody to know that if you have any other SBA loans out there, you can contact SBA and they will cover all loan payments, including principal, interest, and fees for 6 months, which is huge. And it's also available to new borrowers who take out loans within 6 months of March 27, 2020. And this loan forgiveness is not tax-free as far as we know. So you will likely, if you take advantage of these forbearance, you'll probably get a 1099-C at the end of the year reporting your loan forgiveness on this particular piece of the CARES Act as reportable income on your tax return. Disaster loans are not eligible for this type of relief, and this program obviously doesn't cover the PPP loans either. Next slide, please. The employee retention tax credit, won't spend a whole lot of time on this, but it's either this or the PPP program, but you can't do both. So that's I want to highlight that at the beginning. It's essentially a refundable tax credit for 50% of qualified wages up to $10,000 for each employee, so a maximum of $5,000 per employee. It's available to companies whose operations are partially or fully suspended, which is a pretty high bar, or gross receipts that have declined more than 50% compared to the same quarter last year. Again, that's a pretty high bar to be able to qualify for this retention credit. Then it applies to companies that have fewer than 100 employees, a little bit different than those with over 100 employees. Essentially, if you have fewer than 100 employees, all your employee wages qualify for the credit. If you have over 100 employees, only wages paid to employees when they are not providing services to the company. So presumably if you're paying them just to stay home. Next slide, please. And I already said this, it's provided only on the first 10,000, so it's a max credit of 5,000 per employee. And it's for wages paid or incurred from March 13th, 2020 through the end of 2020. Next slide, please. So this is the deferral of payroll tax payments, and this one is not permitted if you get loan forgiveness. So you can get the PPP loan, but if you have any forgiveness, then you're not supposed to be taking advantage of the deferral. And this is really just the opportunity to delay the timing of required federal tax deposits for certain employer payroll taxes and self-employment taxes between March 27th and December 31st. 50% of the deferred amount is paid by December 31, 2021, and the remainder is paid by December 31, 2022. So it just kind of stretches out your cash requirement to pay federal taxes. No limit on the wages that are counted here. This is not forgiveness of anything. It's just deferral of when the payments are due. Next slide, please. So the Main Street Lending Program, we're expecting this to come online again through banks. Not every bank is going to participate, we don't think. So you'll have to find a bank that does plan to participate. The minimum loan size is going to be $500,000. The maximum loan size is $25 million. This is really designed for larger employers. This was really, the PPP loan program was supposed to be for small business. Main Street lending is supposed to be for small and medium-sized businesses. They're saying up to 15,000 employees and $5 billion in revenue is the max size in terms of the company. So these companies are significantly larger than those typically applying for benefits under PPP. Eligible loan amount is 6 times your 2019 EBITDA, less the sum of your existing outstanding debt, plus any committed or undrawn line of credit. The terms, it's a 4-year loan. Principal and interest is deferred for the first year. It's LIBOR, either the 1 month or the 3 month, I think, depending on underwriting, plus 300 basis points. So you're probably going to be somewhere between 3 and 4% in terms of your rate. It's unsecured. There are some strings attached with these loans. You're going to have some of the proceeds the proceeds may not be used to pay down other debt. You may not cancel or reduce existing credit lines. Payment of dividends or distributions is prohibited, so that's going to be difficult, I think, for certain S corporations. Borrower will make reasonable efforts to maintain payroll. Again, no forgiveness available here. You're just making reasonable efforts to maintain payroll, and there are going to be some executive compensation limits on this. Next slide, please. There is you have to be credit worthy in order to qualify. There's the size of the company. So basically, any companies fewer than 15,000 or $5 billion in revenue. You can do PPP and you can do this, so they're not mutually exclusive. And then the principal amortization, as I said before, no payment principal or interest the first year, then 15% principal the end of the second year, 15% the third year, and then the remainder in the fourth year. No prepayment penalties. And again, these loans are not forgivable. I think that wraps up my comments. I've gone a little bit long. I apologize. A lot of information to get through. Renee, I am going to turn things over to you.
Thank you, Paul. We appreciate you sharing all of that information. As we move forward, we are going to focus on some of the more HR and employment related questions and legislative updates. So first of all, Families First Coronavirus Response Act. Again, I'm sure everyone has heard of the different types of leaves, of which we will talk about here next. Just a couple best practices for employers. It is important for employers to document and retain any of the FFCRA leave request forms for at least 4 years from the date of leave. And as a best practice, also be sure your organization has an FFCRA leave request form, and that you've also notified your employees of the new leave legislation and their ability to request it. There are postings that are provided for employers free, and we've listed those as a resource on the resource page that you'll see at the end of the presentation. So next slide, please. So as we talk about the Families First Coronavirus Response Act, and us in HR, we all love acronyms and different things. So I know this is confusing for individuals. So to help clarify, there are two components of the FFCRA and the leaves. The first one is the Emergency Family and Medical Leave Expansion Act, or EFEMLA. And the second is the Emergency Paid Sick Leave Act. Both of these became effective April 1st, 2020, and both of these will remain in effect until December 31st, 2020. Next slide, please. So we won't go into detail on each of these slides. Again, we have provided resources and content on our resource page, but it's important to know that all employers with fewer than 500 employees must comply with the new leave legislation, and employees are eligible for leave after working for an employer for at least 30 days. Next slide, please. We received a number of questions that we'd like to always share with individuals. A lot of companies are asking if the paid sick leave and expanded medical leave requirements are retroactive. So for example, if an employee was off work prior to April 1st, and that answer is no, these leave benefits are not retroactive and will only be effective, again, April 1st forward. Employers are asking, what type of documents should my employees be providing if they're expecting or requesting a leave? Number one is a leave request form that the employer should have, but the employee is responsible for, according to the IRS forms, they're on the website that we've listed on our resource page, they are required to provide documentation from a doctor or a child care provider. Next slide, please. And actually, the next two slides we'll just go through briefly. This just talks through the components of the paid leave. So the emergency leave is payable up to 80 hours of time. And if an employee is asking for additional time, that kicks them into the emergency paid leave. Next slide, please. And we can skip over that one and go to the next one. Thank you. Okay, so we talk about you'll hear it called the EPSLA, and we won't go through each of these, but these are the criteria that employees would need to meet one of or more to be eligible for the paid sick leave. So we'll give you time to look at that criteria that has been consistent since the implementation of the leave. Next slide, please. And this also, the emergency paid sick leave has a provision where the employee, should they meet the criteria of certain levels of what we listed on the previous page, would receive time off at the pay of 2/3 of their regular rate. And again, please keep in mind, we know this is a lot of information we're covering. There are resources cited as we go through this presentation, and also on our firm's COVID website for you to refer back to. One of the biggest pieces of the EPSLA is the ability for employees to request leave for if they need to take care of a child. As you know, schools are not in session when summer comes up. We're not even really sure what the fall is going to look like. So employees that have children in school are more than likely going to talk to their employers about requesting leave as we move forward through the fall semester. Next slide, please. A couple of questions as it relates to unemployment and sick leave. Is an individual eligible for unemployment insurance benefits if they're also receiving paid sick leave or expanded leave? And that answer is no. There's only one type of leave. If an employee is still active, then they would receive leave. If they are laid off or not working, then the unemployment basis would kick in. And we've cited the information here on the website as well for your reference. Next slide, please. Another common question that we are seeing is, if we as an employer have an employee that has been off for family medical leave, say earlier this year, January or February, do they qualify then does FEMLA go concurrent with these new leaves? And that answer is no. In most cases, individual companies should follow their standard existing Family Medical Leave Act and responsible pieces of that for those individuals that have been off prior to any type of the new leaves put into play. And the existing Family Medical Leave allows for up to 12 weeks. Next slide, please. So this is a very common question, and we'll talk a little bit further about this as we move forward. Can employees refuse to return to work based on fear of contracting the COVID-19 virus? And we all know everyone is concerned, and some employees are wondering, is it safe for me to go back to work? What really is their ability to say, I do not want to come in? Per the OSHA guidelines and what we've cited here as a link for you, employees are entitled to refuse work if they feel imminent danger. Now, keep in mind, that's a very broad statement. A best practice that employers can do is to talk to their employees, communicate with them consistently, share the practices that you as an organization are doing to keep them safe by wearing the mask and the PPE, by doing additional cleaning, social distancing, rearranging the workplace settings, or doing different shifts. So reinforce with them that you understand their concern, but also reinforce that you are taking measures to ensure their safety. Next slide, please. We are receiving a lot of questions, and this is actually a national issue. Employers, as you know, have been recalling employees to come back to work, and there are a lot of employees that are saying, I can make more if I stay home and stay on unemployment than I can if I come into work. So what's my incentive to come into work? What can you as the employer do if that is a conversation or that happens at your organization? So let's talk through a couple of resources. Next page. Employers should also remember that you have the right to recall an individual on unemployment at any time. Once you have work available for that individual, you should verbally contact them and say, great news, we would like to have you come back. We need to have you here on Monday, May 16th, whatever the date would be. And also, a best practice is to provide a written recall letter to document, again, we want you to come back into work, and here's the expected date for you to return. Next slide, please. A best practice, again, is to have this letter mailed to their home and then also sent certified as well. The reason that a best practice is for employers to have this letter is for them to then be able to use this as documentation to send to the unemployment office to say, we tried to call John back on this particular day. He refuses to come back. We have work available. That determination and that letter from the employer can help ensure that that individual does not continue to receive benefits. So it does affect their eligibility for unemployment. Next slide, please. And again, we do have the sources cited for you at the end of this presentation. As we go through and we've talked about all the changes, all the updates, all the new things in our new normal, one of the best practices that employers can do is look at your employee handbook. Be sure that your policies are updated to reflect the new legislation that we've talked about. This also helps from a communication perspective. It helps you to ensure that you are consistently administering your policies for your organization, and also helps to mitigate risk for employee lawsuits. Next slide, please. So what should some of those new policies or updated policies be? And that includes just what we talked about before, the Families First Coronavirus Response Act, and the different types of leaves should be identified and should be given to your employees within that handbook. As we all are going through this pandemic now, what is your organization's policy for emergency preparedness moving forward? Paid time off, how does that apply to leaves and in conjunction with leaves? How do you have that defined within your handbook? And also attendance is a big piece of that. Next slide, please. Safety policies should include the following, as we talked about, the new CDC guidelines. What are the employer expectations? At the end of this presentation, there's a resource page for you that provides free downloadable posters for different types of organizations to ensure that you have them posted in your facilities for your employees, and that they have a consistent process as well outlined in the handbook of how to report accidents and anything else related to safety. Next slide, please. And again, these are just best practices that we'll move through pretty quickly. Again, remember, your employees are concerned about their safety. It's going to take time for individuals to get back into the workforce. Be sure that your supervisors, your managers are providing training to the employees when they come back, if they've been laid off or on furlough, to say, here's what our new regulations are for PPE. Here's our expectations of you. Here's where they're located. Go through and document with each employee that you have done that. And that can be as simple as having a signature page after they've completed that discussion. Next slide, please. And again, here's some additional best practices for organizations, you know, in reference to face masks, washing your hands. The link that you see at the bottom of this page, again, provides you with those free resources where you can post those within your facility. And the last few slides are resources for you. There are, as you know, there is a lot of information out there. We really challenge individuals and organizations to be sure you are reading information from credible sources. Sometimes what's on Facebook isn't always 100% accurate, so it's important that you utilize resources. One of the resources here, of course, is our firm's COVID-19 Resource Center that is updated daily. The additional items that you see here on the next two pages are also very familiar, as you have heard, in reference to the unemployment, the Department of Labor, moving forward. So please feel free and use these resources. And if you have questions, you can reach out to us directly as well.
Thanks, Renee, and thank you guys for listening in. We have one question here, just to reiterate something in the beginning there. Paul, can you tell us the date for the safe harbor deadline to return funds again?
Yep, it's tomorrow.
All right.
May 14th. So yeah, tomorrow is the deadline. And again, I don't know that there's much incentive to return it because they did come up with some safe harbors for anybody with a loan amount of less than $2 million. And they did clarify that even if you took a loan for more than $2 million, if when they review your application for forgiveness that they determine you really didn't have a need for the loan, they'll just make you pay the loan back at that point. So there really is not a whole lot of incentive to meet that safe harbor anymore. But if you still want to return the money, tomorrow's the deadline.
Thanks, Paul. And I know we had a lot of content there, so make sure you guys grab the slides in the handout section. And of course, if you guys have any questions, you can reach out to Renee and Paul personally. So thank you for joining us for today's webinar on Summary of CARES Act and FFCRA provisions. We hope that Paul and Renee were able to provide you with some valuable insight in regards to best practices and potential solutions. If you sign up today and realize that you have additional questions, you're always welcome to reach out to the Greater Medina Chamber of Commerce or Paul and Renee directly. Thank you again, and we hope you guys have a wonderful rest of your day.